Welcome everyone to our State of the Industry update. Apologies for those of you who tried to get on Tuesday. Unfortunately, due to some technical difficulties, we had to end up not running it on that day, but thank you all very much for attending today. And obviously we'll give you some further updates on other information coming to hand on some changes, but today's main focus will be around the best interest duty. But before we get to that, just a couple of quick updates on various things. So last week, I think majority of you would have seen that there was a House of Representatives Committee on Economics, which members of our industry, including the MFAA and the FBAA, attended to provide some information and answer questions. It was a fairly pleasing result in terms of discussions around commissions for mortgage brokers, and it was very clear that this committee understands things a little bit better, to the point where the chair of the committee actually came out with that headline that Hayne got it wrong on mortgage broker commissions. So that's been an encouraging sign as we move through the process of having that further review as part of the government's response to the Hayne recommendations about the further review of commissions in 2022. So a good step forward there, and I think the MFAA, the FBAA, and Mark and David from AFG did a good job in terms of furthering the understanding of the industry there. Other great news this week, of course, has been the announcement via the ABA, the Australian Banking Association, about banks being able to extend the deferral of home loan repayments further. They're adding another 4 months as part of a formal process. So this is something you might remember we've talked about in the past, and something that we felt crucial going forward, and we were fairly confident that between government, APRA, and the banks, they would work through this. So obviously that's only just been announced basically yesterday, so we've still got a couple of days. We're still very new into this in terms of where it's at. The key thing around this is that it's not just going to be automatic. It's not going to be as automatic as what it was when the original 6-month deferral came in play. It's going to be a little bit more structured and applied a little bit more rigorously. We have seen some information come out from some lenders to date, about 3 or 4. One of the things we will build is the further resources, so that will go straight into the lender library in Mercury, but we'll also build out a deferral extension programs library to find that information out about each lender as we get it over the next couple of weeks, and build through that. Again, I just reiterate, the key thing that you need to be doing is knowing who of your customers have deferred their home loan repayments and taken that pause to date, and where they will be likely to be at come September, when the repayments are due to start again, so that you have them thinking about it, you're thinking about it, and you've got a plan in place for them going forward, and knowing how to help them deal with the lender. Again, we've reiterated, and we had a meeting within the MFAA yesterday with the aggregators, trying to just reinforce that the brokers want to be involved in that process, but at the moment it seems that will be very much something that it's done internally within the banking systems from there. But we'll keep you posted on that and keep giving you some further information on those things. Not so good news, of course, is what's happening in Victoria, and particularly in Melbourne, in terms of a further lockdown, and in some cases, in some areas, in particular buildings, it's quite an extensive lockdown. So our thoughts go out to Victorians and the Melbourne people who are caught up in that. We know it's quite a testing thing, and it has obviously its mental and potentially physical health implications as well. So we'll touch on that towards the end, but just very cognizant of that, the challenges that sit there. But despite the environment we've been going through, we are still seeing brokers performing extremely well. We've been watching our application numbers quite carefully, and generally the market in terms of mortgage broker applications is still quite strong, and Connective brokers seem to be performing extremely well in these conditions. We obviously had a massive spike in applications towards the end of ANZ's pricing and rebate process. which pulled forward some applications. So we saw a bit of a drop off through June, but the last couple of weeks we really started to see those numbers back up again to some very high levels, sort of back into sort of March of earlier this year. And from a Connective point of view, those applications seem to be up close to 30% year on year. So a good indication that the activities that brokers are doing, the conversations you're having with customers is resonating into more activity for you. So well done to those of you who are embracing that and moving forward with that. From our own perspective, we've been off to a good year, start to the year in terms of new businesses joining Connective. We've had 81 new companies join Connective so far this year, and that equates to about 437 new brokers. So, great to see a lot of brokers thinking about who they want as their aggregator partner, and it looks like a lot of them, like yourselves, have turned and said, we want to use Connective services going forward. Okay, well, let's talk about what we're going to cover off today. So as I mentioned, the real focus today on best interest duty. As we know, the guidelines from ASIC came out, or guidance I should say, came out a couple of weeks ago. So Dan and I are going to talk very much about that, and towards the end we'll just do, we've had a couple of questions come in, just want an update on the merger, and of course to touch on our Connective community, which is our new tool, so be keen to talk about that as well. So let's get into best interest duty, and I'd like to welcome my sidekick, Dan. Hey, Dan.
Hey, Mark. How you going?
Great to be back again. It's a pity we can't be sitting next to each other, but it's going to be a while before I get that chance to get down to Melbourne and head back to have a catch up with you and the team and head to Movida for dinner. But anyway, I'll have to soldier on regardless. So Dan, we're obviously going to talk through best interest duty today. For those of you who have not been on one of our webinars or seen Dan in action, Dan is our group legal counsel and generally heads up all things legal and compliance from a Connective point of view. He's been tremendous in working with a lot of industry on behalf of Connective and on behalf of industry, also working through submissions, understanding things, explaining it to me in a way that I can understand it so that I can make sure we get the right responses on behalf of our brokers. So let's kick into this, Dan. Talk about what we'll cover within the best interest duty component. So we're going to recap on our position. I want people to sort of understand a little bit more about the legislation, and there's two components here. There's legislation and then there's regulatory guidance, of course. And then we'll talk about regulatory guidance, and there's some examples there we'll take you through. And then what everyone wants to really know is, how do I comply with the best interest duty? How do I meet a best interest duty? And then, of course, need to give everyone an update on what we're going to do to help people move through that process, and a couple of key takeouts. And thank you. There's been a number of questions come in. There is the option also to ask more questions on the webinar here. There's a little toolbar on the right-hand side where you can see some questions, and I see a few rolling through already. Well done, guys. We'll get the team to monitor those, and if okay, I won't get political, Andrew Cusack, but yes, 3 cheers for the current government and what they have done to date. So that's a good thing. All right, so looking at where we are at in terms of recapping our position and looking at that. So the submission process. So we saw, and we're talking specifically about the ASIC guidance that they provide around best interest duty here, and that is around the principles-based structure of how you meet a best interest duty. There was a draft version of that came out from ASIC, and that was given, an industry was given an ability to respond to that, which of course we did with Connective, made a submission along with a number of other industry participants. And I'd like to particularly call out Tim Gaspar, one of our mortgage brokers, who made his own individual submission. So there wasn't many coming from individuals, and there's one from Tim, and it again, it reinforced a lot of things that was collectively coming through from the industry. The pleasing thing that a number of things were changed through that process, and further dialogue and discussion, some of which we can talk about, some of which, but it was very good in terms of the way the consultation process was a lot more than what we would normally see in some of these circumstances. But I think one of the things why we were consulted and why we did get to a position where we got to was because industry is also embracing this self-regulatory framework in a much better way. And it appears to me that both government and the regulators trust the industry more because of the way we are approaching it and supporting and working with government regulators to ensure that we get these a lot of these regulatory frameworks in place. So a key thing that was part of in the draft was that there was a significant positioning and reliance on cost or price or interest rate. So it really became clear as with further dialogue with industry that there are other factors that sometimes are actually more important than the interest rate, and one of which is actually just getting the loan approved with a particular funder because of the circumstances of the customer. Other things were timing. You know, if a lender has got the cheapest rate but can't settle in time, then that's not going to be in the best interest of the customer as well. So there's things around that. So that was loosened. The range of credit products and providers. So at one point, the way it read, it would mean that a broker might have possibly had to recommend that the customer go somewhere else because there's a better rate, and because the broker knows that so-and-so had a better rate or potentially a better product, and would have had to suggest to the customer that they should go there and get that rather than the broker being able to provide it. So that's been brought back, and it's now very much a position where it's about you recommending based on your accredited lender panel. So that's changed that quite importantly as well. There's been better definition around what and who is a mortgage manager. So again, it's about the mortgage broker activities where the best interest duty applies. And if a mortgage manager is not acting like a mortgage broker, then that cuts them out a bit easier. Package products, that was the definitions around that were made a little bit better. And Dan and I are going to get into this in a bit more detail. And non-mortgage standalone credit, i.e. a personal loan, for example. So it's still a regulated loan or a credit contract as referred to in the guidelines. And the position around any other regular personal finance, a mortgage broker will still have a best interest duty in the application of or the recommendation of those particular products as well. And of course, our position on this hasn't changed. We were still, we're still very supportive of getting through and getting the best interest duty done, and trying to ensure that we get it implemented from an industry perspective and working effectively. So, okay, let's talk about understanding the legislation. And Dan, being the lead guy you are, I'll let you jump into the legislation piece.
Yeah, no, absolutely. Thanks, Mark. And just to touch on some of your previous points, look, I know we bash ASIC often for getting it wrong or not getting it. I think, you know, we've got to commend ASIC on the process they ran in getting to where they ended up with in the regulatory guidance. I think ASIC did make very clear that they had to operate within certain tramlines, which is the legislation set by the government. They couldn't override, you know, legislation passed by Parliament. But what they did within those constraints, you know, really, they were consultative with industry. They did listen, and they did soften certain things around like cost and range of credit products and panels. So, look, I think all in all, a pretty good job from their perspective. Now, understanding the legislation, and I know, Mark, you and I have talked about this a few times, but just to sum it all up, there's kind of three elements of kind of legislative instruments. Firstly, there was the Act or the amendment to the NCCP, the National Consumer Credit Protection Act. That has been passed. That originally had a live date of 1st July. That has been kicked out to 1st January 2021. That is supported by regulations, which puts effectively some meat on the bones. And then finally, what we're talking about today is the regulatory guidance from ASIC. So it's basically the regulator who owns the legislation and enforcing it, saying, this is how we're going to police the new legislation government's introduced. There are really three key limbs that have been introduced. The first one is mortgage brokers must act in the best interests of their customers. Mortgage brokers, obviously a defined term that we've talked about in the past, someone carrying on the business of assisting with home loans. When there is a conflict of interest, mortgage brokers must place their customers' interests first. And finally, there is a ban on conflicted remuneration. Now, it's really the first two bullet points that we're going to focus on because that's encapsulated in the legislation, and it's what ASIC has talked about in this new regulatory guidance. The ban on conflicted remuneration and all the ins and outs as to what is and isn't conflicted remuneration, that resides within the regulations, that they're still in draft format. A lot of it has already been implemented by the CIF and by the industry in its self-regulation, but we expect hopefully to see those finalised regulations over the next month or so, touch wood.
Yep.
So over to you, Mark.
Okay, so let's have a look at then this regulatory guidance and how to act. As Dan sort of pointed out before, the key thing in terms of how to act is putting your customers' interests before your own interests, and that's crucial. So clearly the focus here is around where they see a broker's interest is around commissions. Okay, that's what they see as that is what's operating in your interest, unless of course this, which the lenders are not allowed to do. You know, let's say they held a competition for you to win a holiday if you submitted the most number of lines. That has been banned, but certainly that would be a classic example of putting your own interests before your customer's interest in that respect. So it's about that priority rule of putting your customer's interests ahead of your own. Disclosure is a key component of how to act. However, disclosure is not best interest duty alone. Just because you disclose something doesn't mean that you've put the customer's interest first, or by explaining this, but then still not meeting the client's best interest. Disclosure is just a key component of what you need to do in terms of how you need to act. And there's been a lot of disclosure requirement changes that the industry has already implemented. That some of that, of course, is disclosing your top lenders and which ones you use the most, the panel of lenders, the commission rates you receive from those lenders. And the objective there is that you're making it clear to the customer that there's very little difference in the commission rates, generally speaking, but where there is, you can see that this one's higher than that one or lower. And if the customer wants to challenge the broker on that, they can, but the broker, you should be explaining that to the customer as you move through it. There's a really good point I just want to call out here that Troy Quintel has made on here, and it's a really good, he's pulled it out of the legislation effectively, but a failure to consider cost and investigate the lowest cost option available to the consumer may suggest non-compliance with best interest duty. Any situation where a higher cost loan is recommended will need to be supported by evidence demonstrating why that recommendation is in the consumer's best interest. So that's a good example why cost is still not said. So the way they've worded that, they're saying is cost is not, we know it's not the only thing, interest rates, cheapest interest rate, not the only thing, but if for some reason you've got you've recommended a loan that is at a higher cost or higher interest rate, you need to explain why. And a lot of that will be because of the client's circumstances, and in some cases, as we talked about earlier, it could be about the timing. I don't want to call out too many lenders, but if there was a priority on refinancing your home loan to get to a cheaper rate, well, ANZ is clearly not the place to go to at the moment if that's not going to meet the client's timing and requirements as well. So there's some of the key things. So look, some good notes and some good points coming through from a few people there, so that's good. Talking about how to act. Product recommendations need to match the client's requirements. So one of the key things that a broker does as in an initial stage with the customers is you do your requirements and objectives, or you fact find with the customer to understand exactly where they're at, their financial position, their affordability, and what it is that they're looking for in terms of the attributes of those products. And in some cases, we know a lot of you as brokers, you'll also uncover and unpack things for customers that they didn't even know were available to them. Talking to George Samuels, who's been doing a lot of first home buyers, he's been putting a lot of them into guarantors, getting mum and dad or other family to be guarantors to remove the requirement for mortgage insurance, as an example. So taking someone down a restructured journey where they hadn't even thought of that is also part of what you can do there. And then in terms of that understanding, documenting those requirements and objectives, and then as you make your recommendation, that you're clearly showing how that recommendation and the product and the features within that product, but also the policy of that lender match back into what is required for the customer. So we'll talk a little bit more on this a bit more, but what this is going to require brokers to do is show the customer and document to the customer more of the research that you do, more of the findings that you make, and the comparisons that you're doing. So we're going to labour on that point quite a bit going forward from this perspective as well. Key things will be around that, as we said, that disclosure. So Mercury does all this for you already. It's built into there. There'll be some subtle tweaks to some of the documentation that we'll bring out, and a little bit around some of the processes where we might build in some other status or tasking capability for you to be able to make sure that you are doing the things that you need to be doing as we would recommend, and in the case of credit reps, as we will be requiring you to do. So Mercury will be, and documentation will be updated to do that. And of course, the ability to keep notes, take notes, keep notes, and record things is a key feature and a key function within Mercury as well that we're making sure that people are certainly utilising. Dan, have I missed anything in terms of how it's administered?
Look, I think with regards to what you said, obviously we'll unpick a bit more in a few other slides. I think one of the key points you made early on is around disclosure of conflicts of interest. The RG specifically says that disclosure or getting a waiver or an acknowledgement of consent from your customer cannot allow you to avoid the conflict of interest rule. You still must decide all conflicts in favour of your customer. That doesn't mean you can't benefit at the same time as your customer. You can still earn a commission, or it can be in both your best interests. However, the customer's best interest must come first, and I think that's really critical. Otherwise, I think, Mark, what we should talk through about examples 10 and 11 from the RG about administration.
All right, we'll just pull up those slides now. So one of the things in the actual guidelines, and I'll talk to us a bit more about reading these guidelines. It's a 52-page document, including a few pages where there's really not much on there. But one of the great things ASIC have done in releasing these guidelines is they've provided heaps of examples along the way and scenarios. Now, a lot of this the scenarios was a big thing that when ASIC asked for industry consultation and wanted submissions, they encouraged a lot of scenarios in there, and it was really good. That helped them glean and understand a bit more about what a mortgage broker actually does. We're not just there comparing interest rates, we're doing a whole range of things. So you'll see in these scenarios, this is about when does a best interest duty apply when you're doing a home loan health check on a customer. So this is the other big thing. A best interest duty is a point in time duty. It applies when you're providing the credit assistance, but there's certain structures around what constitutes that in terms of that credit assistance. And in this case, it's very clear that if you are arranging for, in this case, Annie to change the pricing on her loan, still with the same bank, no new money, then best interest duty does not apply. If, however, Annie wants another $10,000, then you must apply a best interest duty process to that. So changing or switching a product or changing the interest rate, hopefully downwards, for a customer as part of a home loan health check, still at the same bank, does not require best interest duty, but any new money changing to another bank does require the best interest duty application. There's another example.
Or even the decision.
Sorry.
Or even the decision to, you do a health check and you go, actually, you're probably still in the best loan for your interest at this point in time. Best interest still applies in that circumstance as well.
Yeah, we could change it, but here's the cost to change. Here's the difference in the savings. So we're saying with the status quo, that's fine. So best interest duty doesn't apply yet. So that's been, and I think what part of ASIC's intention here is to encourage and enable brokers to be able to continue to support the customers and do a great job of renegotiating the rates without having to have a lot of shift, but also ensure that customers, and there's no sort of new barrier for customers to sort of go through that process and allowing brokers to do that, because they realise that that's a great objective what brokers do. Look, example 11 is just a further one where it's just a similar example, but where there's no credit assistance. So what we're trying to highlight here, guys, is please have a look at the guidelines, and please particularly make sure that you have a look at some of these examples, because they really do help you in your mind think about, okay, now I see when this applies and what I need to do in this respect. And of course, from a Connective point of view, we will be here along the way. All of your compliance support managers are there to support you and help you with any inquiries or scenarios or any questions as we go. But we're going to talk about more about support going forward later. Dan, there's some specifics that were called out also about ACL holders. So as we know, there's a number of Connective broker businesses that have their own ACLs. And what's the implication? Because, sorry, just to define the point here to the listeners, best interest duty applies to you as the person as you're conducting the job and providing credit assistance to that customer. So it's, while the ACL's job is to make sure that best interest duty is being done, it's up to the individual person how that best interest duty that applies down to them. But ACLs are not off the hook, are they, Dan?
No, that's absolutely right. Obviously, a lot of it, and the actual people on the tools, the mortgage brokers, there's a lot of guidance as that. But ASIC call out also that there are responsibilities on the credit licensee as well, Connective being one to a very large number of our mortgage brokers. And I think what they've stated is credit licensees need to take reasonable steps to ensure that their mortgage brokers or their credit reps are complying with the best interest duty requirements. Now, what does that mean? What does reasonable steps mean? Well, that could be monitoring, education, file reviews, supervision. Obviously, they're not prescriptive as to what reasonable steps means, but obviously it's scalable depending on your size, your business, the activity of your credit reps. What's really interesting is also 2 points that they've made is it's not only just picking up on contraventions when they happen, reasonable steps also includes steps you take to prevent contraventions occurring in the first place. So you need to be proactive about this. Secondly, they've also stated that the credit rep or the mortgage broker may comply with best interest duty, and you as a licensee may still be in breach if you're not taking reasonable steps. So look, I think for all our ACL holders out there, I think you need to just have a read of the relevant section, bear this in mind, and think about what your activities and your supervision and your monitoring of your credit reps are at this point in time, and whether you need to just buff that up a bit more to ensure you continue to comply with the RG.
Yeah, and we're in the process of building out some guidelines for ACL holders, and we're also going to hold some webinars and training sessions just for the ACL holders. So for those principals of businesses where you're holding your own ACL, we're putting together a bunch of stuff specifically to support you in and around that as well. So we'll have that coming out to you as we move through things. I guess one of the things that we'd really love to have before we sort of get too far down the track in terms of training is the further guidance in terms of the legislation, so that we've got the whole package bundled up. I know it's sitting on Josh Frydenberg's desk as we speak, so hopefully, he's a pretty busy man at the moment, so but hopefully we'll have that soon, and then we can sort of put it all together. But they're not going to stop us getting in the way of making sure that we really work and make sure everyone knows how to act and how to make sure you're meeting the best interest duty from certainly from this principles-based best interest duty in respect to prioritising the customer's requirements and doing those things going forward. Dan, let's talk next about how to comply with best interest duty in terms of some further guidance around this. And this is, again, getting onto one of your favourite subjects about making sure you keep Most of that is to defend yourself against an African complaint these days, but there's certainly an element of this that the best interest duty will actually help put in practices with brokers such that should there be a problem down the track, brokers will be in a better position probably to show and how they got there and why they've done everything they possibly could and done it in the right way.
Yeah, no, thanks, Mark. I mean, look, that's a really good point. Obviously, I think, and I've said this on many forums, that one of the things that keeps me awake the most at night is around AFCA and AFCA complaints and being able to appropriately respond to that. Now, on one hand, you've got quite a detailed prescriptive regulatory guide that tells you what you should be doing in certain circumstances. So on one hand, that's a bit more of a burden, and another stick AFCA might have a go at you on. But on the flip side, it gives you some pretty clear guidelines as to what you should be doing and behaving, and recording and note taking as a defence if such a complaint ever so arose. So I think, there's two ways of looking at it. Now, just to unpick it down a bit more for you guys to go through the key steps. Page 10, there's a table in the regulatory guidance, gives a really good snapshot, and it's broken down into these three key headings about gathering information about the consumer, making an individual assessment, and presenting the information and recommendations. And they're the real key headings for you to think about as you think about complying with the best interest duty. Thank you, Mark. Before I kick off into that, two motherhood statements. Firstly, Connective's position has always been, and we continue to believe this fundamentally, is the greater majority of our mortgage brokers are already complying in spirit with best interest duty. There are some subtle changes to your procedures and practices that you will need to introduce over the next 6 months to get best interest duty ready. But overall, we actually fundamentally believe that you're already doing virtually everything that this RG talks about. You might not be presenting the information or writing it down in a manner that's compliant, but you're already meeting it. So that's great. The other thing is there's a big overlap with responsible lending obligations. So a lot of the things I say here, you should already be doing in compliance to your responsible lending obligations. Obviously, best interest duty is in addition and over and above of responsible lending. So they are two separate obligations of yours. There is overlap, but you should be already doing a lot of it just by complying with your responsible lending guidelines. So going down these headings, I'll just give some key points. Gathering information about clients, it's the same as your responsible lending obligations. You need to know what their needs and objectives are. You need to understand their financial position, you need to make reasonable inquiries, and then you need to take reasonable steps to verify the information you've got. But there's no magic to that. I think some points that ASIC make is, I think 2 points is have a questioning mind when you get the information. If something doesn't smell or sound right on the face of it, ask more questions and then document the response. So just be inquisitive. Don't just accept a bucket load of information on face value and move forward on that basis. I think ASIC are really impressing that point onto mortgage brokers. And then secondly, ASIC state you might not be able to get everything in one go. You may need to go back and ask further questions, or circumstances may change during the process. And you can't just rest on the fact that, I got this bundle of information on day one and rely on that for the entire process. So be inquisitive and, don't just rely on the packet of information you got on day one. Continue to ask questions over the process. The next one, making an individual assessment. Again, it's all down to your individual judgment. ASIC, as always, they've given us a principle-based regulatory guide. It is not prescriptive. It's not one size fits all. Look, I think a couple of key points, because I'm not going to go down to every single point. I think when you first assess your customer and you get the information, you see their situation, and it's something we'll talk about later on this month when we talk about complaints and PI in the second series of our webinar series, is you need to make a pretty rapid assessment if you can provide credit assistance and comply with best interest duty or not. If you don't think you can do that, refer it on or politely say to your customer, sorry, I'm unable to provide credit assistance to a best interest duty standard. Protect yourself, because unfortunately, we've had recent cases where brokers have tried to help customers in really tricky, difficult positions, and it's come back to bite the broker. They've been found to have been providing credit assistance but not met the required standards of the legislation, and they've suffered a penalty from AFCA as a result. So that's one of my key observations on that.
Dan, I might give an example here. Say, for example, a reverse mortgage. You may not be accredited with any lender to do a reverse mortgage. So in that case, don't try and fuddle your way through and concoct something or do it, just say, I'm sorry, I can't help you with that. There are certain lenders or there's some other mortgage brokers that specialize in that. I can suggest you go there. If you are taking a referral fee for doing any of that, you need to make sure you're disclosing that quite clearly, and you still could be caught up in any potential complaint action if you were the initiator of that referral, you were getting a fee, and somehow or other the person where they went to stuffed it up. So just be very, very careful around that as well. I am keeping an eye on some of the questions coming through, and I've got to say they're flowing thick and fast. I just want to double check one thing. The price and best interest duty, this comes from Stanley. How do we forecast what different lenders will be doing regarding interest rates and decreases over a 30-year loan term? Just want to pick on that one because, again, I want to go back. Best interest duty is a point of time. So that's why when you do your product comparisons, you are keeping a record of them. And Mercury does that, it automates that. When you do it within Mercury, every time you do a comparison, it actually holds it against that loan file or that opportunity as it is. So it's got it there as a point in time, and it's time and date stamped. So you've got a great audit process there. But when you've done that, picking on what are those rates and it's that information there, it's not asking you to predict into the future that this bank's interest rates will go up. And you can't, and that's why it was very clear, and that's why, because otherwise you're doing a best interest duty right up to the day of settlement, because someone can come in with a better interest rate the day before it settles, and what do you got to do? Try and change it all around? It's just not going to happen. So just wanted to jump on that question. We'll get to some more questions later on as well. So Dan, we were up to
So look, thanks, Mark. So look, cost. Obviously, we touched on it. Cost, although there is no presumption now that the cheapest loan is the best loan, ASIC do say that cost should be prioritised. And if you don't, out of your panel and the products that are available to you, if you don't offer or at least mention the cheapest option to the customer, you may fall foul. You might not land on that, and you need to explain why you didn't land on the cheapest option. But ASIC, although there's no presumption, they still want you to prioritise costs as one of the main factors to consider. Now, ASIC give a really good example. I think it's on page 15 of the RG example 1, where they talk about going to a no-frills lender, and it's all the cheapest interest rate, but actually it was better served for the customer to go to one with an offset account because they had a bit of extra money, and all in all, the cost would have been cheaper. So, cost, it's a multi-layered beast cost. It's not just the headline number. There could be, upfront costs, annual costs, etc. If it's a fixed rate, rate costs may need to be factored into. So cost is still a really important factor that you need to bear in mind and at least present. I think the two other things are, one size does not necessarily fit all. You can't keep on rolling out the same, option every time to every customer. You need to judge each customer on their individual facts and circumstances and preferences. Look, I know one of the questions that came through, and I'll answer that early, is yes, Connective will start looking at a bit of your lender submission data, and if there's any red flags because you're sending a whole lot of volume to one single lender, we may pick up the phone and just go, was there any reason? There might be a really great reason, right? They've got the sharpest rate. The service is amazing, combined with a really great rate and a great app, right? That's cool. But we will start looking at your lender biases in due course.
Just another one here, Dan, I just want to pick up on, and because a couple of people have asked this question, and again, it's getting back to examples 10 and 11, where you're basically keeping the customer at the same lender, but changing products, not applying any more new credit, because it's not going to another bank. Now, people are a little bit confused, and I think this is around our guidance to our credit reps. And we provided an update on this guidance about 4 or 5 weeks ago, where if it is just a simple product switch or a changing of interest rate, or so going from a variable to a fixed rate, fully or partially, a full assessment is not required. Best interest duty from 1 January will not apply. ASIC earlier this year reinforced their guidance around this, which enabled us to update our guidelines on that as well. There are still some lenders that are not are still requiring the whole responsible lending process, even when it's only a simple interest rate or product switch. They're, from what we see, they're out of step with what the guidance is from ASIC and also even from APRA in that respect. So that's just a further update. So that guidance, it's probably sitting somewhere within the compliance manuals within Mercury, I imagine.
Yeah, look, I think, thanks for raising that, Mark, and I totally agree. I think my view is if a customer comes to you and said, look, I'm happy in my product, could you pick up the phone and get me a cheaper rate, or could you change one of the elements, or just help facilitate a change to my existing product? That's not credit assistance in my view. Now, if a customer comes and goes, hey, can you have a look at my whole portfolio? Can we do better on my rate? Can we talk through some of my future strategies, etc.? Well, then you're in credit assistance zone, right? So I think there's a pretty clear line. If in doubt, right, if you're doing a bit more than just facilitating a variation to the existing product, that's when you start moving into credit assistance, and then best interest duty probably kicks in then.
Yeah, exactly. Yeah, probably the stage is, okay, let's understand that, but if we need to go further, then I'm going to need to reassess your financial position if we're going to do restructures, extend terms,
exactly.
like that. So, yeah, very good.
Correct.
All right.
The last bullet, I'll be really quick. Presenting the information and recommendations. Look, it's the one thing we've talked about in the past, and it's probably the biggest change you will need to make to your practices. It's all about this narrative summary. So once you've gotten to the end of the process, you need to tell the story to the customer. You told me this is what you wanted. These are the products I looked at. So where possible, try and present more than one product recommendation, and this is the one I've landed on now, and this is why I'm recommending it. So it's telling the story. How did I get to this spot? This is why I'm recommending it to you. Now, the customer may turn around and say, no, actually, I like the color of this bank's credit card because it's pink, right? And you can go, well, it's not as good as this one. But if they still want to go there, note it down and move on, right? So look, that's all I can really, it's all about telling the story and putting that writing and putting it to your customer. That's the simplest way. And as I said, where you've got a product comparison, try and put the cheapest product within that product comparison, just so that you've looked at the cheapest option. Yep. You might not recommend it, but at least where possible, show that you've looked at it and considered it.
Yeah, so that was one thing. If there was one area that ASIC had been critical of the industry on, was that they knew comparisons weren't being done, but they were seeing that these comparisons weren't being shown to the customer. So they felt that could be done, and it's a good, healthy thing to do. It validates things more and makes the customer a bit stickier too. All right, we'll quickly move through what we're going to do to support. A lot of questions coming through on this, so we should answer most of those questions through this process. But all I can say is, in terms of what we're going to do to support you, is a lot. And Dan and his team are putting together some stuff as we speak around this, but just give us some quick updates on that, Dan, what's moving forward.
Yep, thanks, Mark. Look, the total end game is really what we do in Mercury and trying to assist you digitally across the entire process. That's currently in works at the moment. Hopefully we'll roll that out some stage in Q4 so that we can allow for appropriate training and you to get full reps on the full process before 1 January. So that's the end game. In the interim, where my team's already reviewing our existing NCCP documentation that we provide you guys with, and seeing whether we need to make tweaks or amendments to start getting a best interest duty ready. As I said in the previous slide, the key document that we're going to start putting together is what we call the narrative summary and product comparison document. And my gut tells me that what we're going to do is we're probably going to expand on the CPD, the credit proposal disclosure document, to create a front page narrative summary. It's not going to be digital at the moment, but what we'll do is we'll put some headings and key guiding questions for you to think about to allow you to create that kind of one-page cover, and also for your product comparisons to go in. We're also going to prepare some email templates some note-taking templates, and some more fact sheets. Easy little fact sheets or paragraphs that you can send out on what an offset account is or fixed rates, etc., that you can easily send out to educate your customer as you take them along the journey. And obviously, we'll do training sessions, as we get closer to 1st January, just to help you guys feel comfortable that you are best interest duty ready.
Fantastic. Yeah, so a lot of things coming through there, including my Uber Eats, I think. Dan, so there is a lot, and I think we might move on to the next one in terms of some key takeouts. So these are just, I guess, talking to what are some of the important things, I guess, we want to recap on in today's presentation. Obviously, the key thing you need to be doing right now is meeting responsible lending requirements. Okay, so that doesn't change. That's always been part of it. And if we can get better at doing that, it gets us closer also to getting into that best interest duty stage. Putting your customer's interest before your own. As Dan said, our position has been that we think that largely Connective brokers operate within the spirit of best interest duty, and that is because a lot of you put your customer's interest before your own. That's why you have these customers coming back to you, referring lots of business to you, etc. Conduct product comparisons and show your customer those product comparisons. As we say, they take them on the journey with you. I think too often we spend so much time on these things, we actually forget that sometimes these customers are the first time, or it's something that they haven't done for years, and if they don't ask the questions, we don't maybe explain enough about what is going on and communicate to them so they understand what is happening, the complexity. Why are we asking for all these pay slips, or all these bank statements? What is the case? We're not doing it for fun, I can tell you that. But it's part of meeting that responsible lending requirement. And then, of course, recording the journey, keeping detailed notes. It's very simple to do with Mercury. Emails coming in, going out. It's very easy to add them into the opportunities without having to cut and paste and do various things. So avail yourself of that. And of course, with Mercury, we're going to be running some sessions on this. There's a lot of new tools coming into Mercury, which will also enable some more automation of some of those processes of collecting documentation, etc. And of course, a big thing too is using the statement gathering and expense and income. Cash deck, cash deck. Yep, perfect. Okay. So I guess in summary, in terms of around some of this, it's subtle changes to your processes. That's what it should be. If you've been doing and following the requirements of a lot of the stuff we've been talking about in the past, particularly with our credit reps, then you're largely there. It's showing your customers more of the information, particularly the product comparisons. We obviously will need to make bid, but it starts on 1 January. So we've got some time ahead of us, but judging by a lot of questions, it's going to be a lot of information. So we'll go to a couple of questions next, but there are a lot of questions that we need to distill, including some that came through in the beginning. We are going to be running a number of different seminars and training sessions on best interest duty. Today, when we knew we weren't going to cover everything, particularly within 1 hour, but we don't want to have laborious, lengthy half-day seminars. We're going to give it to you in absorbable and understandable bits and pieces as we move through it. And of course, there's still little pieces that we're still waiting to land and some further clarification. And I know the industry associations are doing a great job to try and determine some of that and get some further discussion with ASIC and Treasury around making sure that we're getting it right and we're understanding it in the clearest possible context. A lot of content will be coming to you in terms of fact sheets, tips and guides. Formal training processes will start through October and into November, and this will include credit reps and ACL holders. And so by November, we really want everyone to be able to put into practice full best interest duty requirements for 1 January, so that through November and December, you're already doing it and you hit 1st of January. And if you can peel yourself off the beach to go and write a home loan on the 1st of January, you'll be getting a best interest duty as much as we can straight away. So that's sort of the process and the journey we want to take everyone on through that from that perspective. How are we going?
Questions? Have we got time for questions?
Well, we'll get through it. Let's do a couple of questions here, Dan, because we'll just pick on some of the ones that have come through beforehand because
Yep.
Because we're prepared.
I'll do the first one, Mark, to you. Look, we got a lot of questions about clawbacks, and I know clawbacks isn't touched on in the RG, but a lot of you guys are asking. So Mark, just what's going on with clawbacks? Just recap what's going on there.
Yeah, well, that was very much in the legislation. You can't pass a clawback onto a customer. No matter how well you might document it and make it clear to a customer, you can't pass a clawback onto a customer. You can charge fees to your customer, but if your fee relates to the clawback, then that's sort of what we call an anti-avoidance provision around trying to get around some legislation, which is against the law in its own right. And there's, in fact, Dan, you touched on it, but there's anti-avoidance reminders through these guidelines too. So the overall picture with clawbacks though is there's a lot of discussion happening in and around clawbacks right now, and there certainly is a big push to get a more balanced approach to commissions overall. Upfront commissions to brokers have suffered because of the net of offset utilisation calculation, and different way lenders have approached that. Some have got it better than others, and we're working through that. Unfortunately, we can't do it as an industry because the ACCC sees that as a competition law issue, but certainly there's a lot of discussion and dialogue, and everyone generally is moving in the same direction. The same thing with clawbacks. There's a lot of pressure on clawbacks, and it was also raised in the with the committee at the House of Representatives as well, and certainly clawbacks are going to be getting a fair bit of scrutiny in terms of how realistic they are, how practical they are. And again, there's some lenders that do a little bit better than others. And we've got to be careful that these types of commission structures, whether they be an upfront payment or a clawback, what they have done is created more conflicts in terms of which lender might be better for a particular circumstance with a particular customer than another. So that's that question on clawbacks, which we'll jump into. As I mentioned, we've got a heap there. What we might do, Dan, and I know we've got Andrew and Laurie and Chantel on here too, we'll pull apart a bunch of those, and we might run another specific session around best interest duty, just almost purely based on answering those questions through the conference and coming back to those questions. And it's great because the questions are important for us in terms of framing what type of information you further need. A bit like you guys as brokers, when you're talking to a customer about a home loan, you've got it all, you do it all the time. I guess Dan and I have been working on this for almost years and going down this path. So we sort of sometimes we think, okay, we know that we don't need to cover it, but look at some of the questions, we do need to go over it. I will reiterate, please download the guidelines, 52 pages. It's an easy read. One thing I will commend ASIC on is they have actually put together some guidance which you can read and you can actually understand. It's quite good. So don't be afraid to wade into that and have a look at it. And again, think of any further questions from that you can do. Then we really don't have any more time because I've got a couple of last things to cover off. Just want to thank you for your support around this and where we're going and how far we've got to date. And obviously some assistance with submissions and various other things that we've got here. And we've landed in a much better position than where we were at the beginning of this process. So that's been great. Just a couple further little quick updates. On first one, there was a questions beforehand because this is again is a state of industry update. It's not just purely best interest. A merger update. The ACCC not opposing the merger was not. It's not the last thing we need to do done. We've still got to get a court approval process in place, and we're waiting on that. Again, answering some of the questions, we're going to continue to operate very much. So nothing changes now. There is, well, the merger is still on the horizon. It's on the horizon still. It's not being implemented or happening as we speak. So Connective and AFG right now are operating very separately, and we're still going at each other's brokers hammer and tong. But as we move into that merge process, then the businesses will still operate as separate entities, into separate businesses in terms of the structure and the way we operate things. And likewise, Mercury, we've spent a lot of time and effort over the last 12, 18 months in making some changes on Mercury. That will still go ahead, and you'll see some significant updates to that coming out probably around August of this year. And of course, well, and as I understand it, AFG have been spending a lot of time on their software platform as well. So they're in the process of going through a relaunch of that as well at some stage as well. So from a Connective point of view, it's business as usual. And even through a merger, it'll be the impetus is on us to continue to provide great service to you guys and great tools such as Mercury. Otherwise, we don't retain your business, and that's been a core aspect of what is part of our whole operational excellence, is that we're focused on making sure we deliver, because we know that if we don't, you have other options available to you. So that's always kept us very much focused, and I think has been part of our success and our DNA in the past. And of course, we'll keep our focus on supporting you, our brokers, and also the industry as a whole from that perspective. So that's on the merger. One of the other things I want to talk about is Connective Community. So we've launched the Connective Community recently. It's a great little tool, and so for those of you, I think that we've got about, when I looked at it the day before yesterday, there's about 1,300 users on there. So there's a whole range of things in there, but it's an ability for you to, within a closed Connective Community, you've got to be a Connective broker to be able to get into the Connective Community. There are certain groups within the community as part of the broader community as well. There's a Mercury tips and tricks in there, so brokers can go in there and put in some of their thoughts around some tips and tricks and things that they might be doing. So it's a peer-to-peer platform to enable you to share or ask questions. And one of the ones which is interesting is the loan scenario section. So that gets a lot of use, that group. It's great to see brokers coming in, putting in some of the queries they might have or tricky loan scenarios, and seeing other brokers coming in or some of the Connective staff coming in and providing some thoughts around what are possible solutions. Of course, we've got a Melbourne Business School program. We've got a group in there for that, and that's been, people sharing their thoughts and ideas. We had the first one around the economics side of things and how that's all working. That got a lot of thought-provoking discussion, particularly around quantitative easing, negative interest rates. And of course, the one we ran yesterday around disruptive strategy as part of a two-part series, that's created a lot of thought as well, as people are looking at strategy versus operational excellence. And of course, our Empower series has a group in there as well, which is very much about supporting you and looking at, and in terms of Empower, it's about looking at the whole process through the lens of one of your female customers and understanding how best to meet their needs as well. So that's Connective Community. It's a terrific tool. Please make sure you use it. Finally, obviously what's coming up is a further roadmap in terms of best interest duty from now until December, the content, the webinars, the training that will come through in a broader sense, and then the specific training that will come through from your compliance support managers. Mercury, in terms of its further development, further stuff on that in August, which is coming up very, very quickly. And obviously the learning and development programs in full swing. We've got more sessions coming up with Melbourne Business School. We've still got 5 more to run. We'll also have our keynote speaker series, and we've got our broker champion series that we'll be rolling out to you as well as another lender splendor coming your way. So plenty to do. If you're in isolation, again, if you're in lockdown, thoughts go out to you. Just a couple of quick points on that, some tips and tricks that we're certainly, obviously I've got a lot of my staff, a lot of our staff are in Melbourne, Melbourne based, and so we're very conscious of helping them. Here's a couple of quick tips on how to cope with being in lockdown. It's about reframing I'm stuck inside to perhaps I can focus on my home and myself again. I know that's hard, particularly when your house might be full of other people. Try and stay as close to your normal routine as possible, i.e. getting up, either going for a walk in the morning, have a shower, or that's if you're allowed out of your unit, having a shower, getting dressed, getting out of the pajamas, not wearing active wear all the time, and try not to have your Ugg boots on 24/7. So the other thing is avoiding obsessing over endless coronavirus coverage. This is a really tricky one. I generally try to sort of look at the coverage, particularly on ABC News, for about 15 to 30 minutes a day, get the key highlights, and don't get too caught up in it. about what's happening from that perspective. I think it's been, it's managed really well. While we've got a situation in Melbourne and in Victoria, New South Wales, again, yesterday had no community transmission cases again. So there is the ability to manage it. And I think overall, from an Australian perspective, we're on top of it. So it's a positive thing. Look, a chaotic home can lead to a chaotic mind as well. So, one of the things that Fiona and I have been doing on some weekends is we're just picking a particular area. Sometimes it might be a cupboard, or it might be a wardrobe, and just Marie Kondoing it. Going through it, decluttering. We cleaned out all under the sink, found all these dishwashing things that we hadn't been using, probably never will, threw them out, creating new cupboard space, and just feeling less chaotic. So just maybe practice a bit of Marie Kondo at home. And if necessary, start a new lockdown ritual. If you are in lockdown again, think, okay, what can I do differently this time now I'm sort of stuck at home? Maybe there's some other things I might want to try. I tried cooking a lot, which distracted me by the time it came time to sort of put down the pen and turn off the laptop. And it was a great way to sort of reset your mind and not be thinking just constantly about work or constantly about the coronavirus. Actually reading a recipe and trying to make it. Sometimes that can be tricky. Look, guys, that's all I got for you for now. Thank you very much for tuning in, and we'll be back to you very soon with further recap on the best interest duty. You don't have to do it tomorrow, but we will be making sure that you're going to be closer to be able to do it before we get to the end of the year, that's for sure. Okay, thank you all very much.